So good afternoon to everybody. I am so excited that you all took time out of your day to come to this event. This is a big one in my book. And I guess I'm the guy responsible for putting this together along with Sherry Taylor. So kudos to Sherry because she does a lot of work behind the scenes, and I hope you all take time out to thank her for bringing us together this afternoon. As I mentioned, Justin Mackey is with us from our headquarters today. He is filming this event. Our intent is to get it out to your intranets website so that if anybody on the outside wants to take a look, they'll be able to do so. And anybody on the inside, same goes. If you all want to take another peek at this presentation sometime in the future, I hope that you will. All of you know I'm Keith Warmbine. With me this afternoon is Al Shindren from American Century Investments. Al comes to us from Kansas City, so he's traveled a long way to give you some very helpful information. I have long said that retirement is a three-legged stool, right? Leg number one is Social Security. It's a big one, right? Leg number two is your retirement plan here at Pitt, Ohio. Or if you move on to some other company, it's of paramount importance that you are participating in it because it's part of the stool, part of your financial future and your future paycheck. Leg number three, your personal savings. Altogether, it's going to make up your future paycheck. As I get around to talk to people, some 9,000 of you a year, I hear a lot of questions around Social Security. I hear it from widows. I hear it from widowers. I hear it from divorcees. I hear it from just ordinary people that they have so many questions surrounding this subject of Social Security. Well, this afternoon we've got an expert. Al has given this presentation 300 to 400 times. He speaks to Social Security all of the time. American Century being one of our mutual fund partners, I thought it a good idea to have this gentleman come in and chat with all of you. So thank you again for attending. If anyone would like this handout, I would encourage you to send me an email. I will send it out to you anytime. Just reach out and I'll get it right out to you. Good afternoon, Michael. Without further ado, Mr. Shindren.
All right, thank you, Keith.
Thank you.
Good afternoon, everyone. You know, it's great to be here, and I will tell you that Keith's right. I've given this presentation 300 or 400 times, but I always think it's an interesting story about how it started. We had a company that we work with ask us to put together a Social Security Administration presentation, and I thought, you know, why? The information's out there already. So I kind of put it off for a year or two, and they finally convinced us to put it together for them. So after 5 books and countless hours on the Social Security Administration's website, I developed this presentation. So it's a little bit different than maybe what you've seen, and I'm hoping this will work. There it is. I start out with the basics. I talk about all the different benefits there are available to you through the Social Security Administration. We talk about when's the best time to start taking Social Security. These are general guidelines. Everybody's situation is different. So depending on, you know, what your goals and objectives are in retirement, how much money you have saved up in the other 2 legs, gives you flexibility in terms of how you want to take advantage of Social Security. But I have talked to individuals that didn't understand how it works, and so they've missed out on an opportunity to collect Social Security because they thought, for example, they were still working and were not eligible for Social Security, which is not true. It's driven by age. We'll go over that information as well. Stop me if you have a question, or if I'm talking too fast or you can't hear me, let me know, right? Because this is all about giving you information. I can go through this fairly quickly because I've done it a few times, but I want you to know that. I always ask a question if anybody is an expert in Social Security, right? Yeah, usually that doesn't no one answers that question. I was giving this presentation up north of Washington, D.C., and a woman in the front row raised her hand. I said, well, you could probably give this presentation then. And she said, no, thank you. After the presentation, I found out that she was a 30-year veteran of the Social Security Administration. And her specialty was coordination of international benefits. So the good news was that she said, I didn't have to correct you once. He said the last presentation she had gone to, she stopped him 3 times and said, that's not right. So either I have been fortunate enough that I stick to what I know, but I think I can pretty much answer questions. And if I don't know, I will tell you, you need to call the Social Security Administration to get a full definition, because it's easy to go over the general numbers, but when you get into specifics about individuals, they have their website available to find out information on it. I think it's worth verifying that information as well, but if it doesn't sound right, so the purpose of this today is to give you an idea of what you're eligible to receive, how they actually calculate those benefits, and then if they give you an answer that doesn't sound right, ask for a supervisor. You know, move it up, because they don't always give you the right answer. All right, this thing's... So I always start with where it started, the beginning, Act of Congress in 1935. When it was passed, the average life expectancy for women was just under the age 64, for men just under the age 60, and you were not eligible to collect Social Security until age 65. All right? Half the population didn't live long enough to actually get there. Now that's a true statement, and it isn't. If you were born in 1935, those are the right life expectancy dates. But if you were 65 in 1935, it was about a 10 or 11 year time frame that they were looking at for life expectancy. So when they started the program, it was expected to run maybe a 10-year time frame on average. Today, anybody know what average life expectancies are? About 84 for men, 86 for women, so almost twice as long. And I think Society of Actuaries just basically came out with new numbers thinking it's 86 and 88. So we talk about that as part of the process as well. The other thing was originally just retirement benefits, and they added disability benefits in 1956 and survivor benefits shortly after they enacted it in 1939. So there's 3 different types of benefits that are available, all under the umbrella of Social Security. Now, a lot of people get confused and think Medicare is under the umbrella of Social Security as well. It is not. It's its own separate group, but where the confusion lies is that your premiums can be paid out of your Social Security check. So a lot of people think they're somehow connected. They're not really connected other than that premium payment. The other thing I mentioned about Social Security is that it's unlike most retirement savings programs, because it has a cost of living adjustment associated with it. Now it could, in this year, was actually a 2% increase, but it could be 0. And we had a couple of years that, in fact, since year 2000, it's been 0 3 times. So the average since that date is about 2.16, and this year it was a 2.0. Funny story about that, my sister-in-law cornered me in February and said, wait a minute, you told me there was going to be a 2% increase in my Social Security payment, and I didn't get any increase? And I said, that's because your Medicare premium went up 2%. So in the years in which you get a Social Security increase, your Medicare premium can go up as well. Sometimes that offsets each other. It's not supposed to ever decrease your Social Security payment, but it could potentially eliminate any potential gain. All right, so how many people? 66 million people as of December of last year. And I always kind of tell the story because if you read 3 different reports out of the Social Security Administration, right, they're all from the Social Security Administration, you could see 3 different numbers. But 66 is the one they printed in their fast facts and figures that comes out mid-year, and it basically says that of those 66 million people, 20% are receiving a disability check, 70% are receiving retirement benefits, and 10% are in that survivor insurance category. So largest source of income for most elderly people, defined by the Social Security Administration as age 65 or older. Okay, so that's how they define that. I think this is behind me, so it's not working very well. Oop, there we go. A lot of times when we talk about retirement income, we look at replacement values. And I put this information in there because it demonstrates how the system was actually developed in 1935. It was written so that people were in a lower earnings category received a greater benefit in terms of the retirement calculation. So all this is showing is that scaled medium, scaled high, and steady maximum, which are all Social Security Administration calculations, says that you'll have a 41% replacement value. So if your average earnings is just under $50,000, then you're going to be eligible to receive about a $20,000 annual retirement benefit through the Social Security Administration. On the middle tier, it's almost $79,000, which gives you a 34% replacement value, which is $26,500. And the steady maximum earnings represents taxable wage base over time. Now, taxable wage base is the last dollar amount you pay Social Security tax on. So if this year, if you earn in excess of $128,400, you no longer have to pay Social Security tax. And the interesting thing about that is that 30 years ago, that was closer to 30,000. But they don't count any dollars over those numbers. So taxable wage base can change from year to year. It doesn't change every year, but it can. And that's the maximum income level they look at in terms of calculating a retirement benefit. So for those individuals that did fall into that category, 27% is the maximum replacement value. Again, never developed to be a full pension or a full retirement program. It was just part of the, it was basically a floor amount. And so we'll look at the numbers here in a minute about what they actually are. But again, in order to get a full retirement income amount, you really have to depend on those three legs of the stool that Keith was talking about. So here's the number. This is the category I wish none of you will fall into. I would hope that. And it really says basically if we're looking at the group of people where 50% of their retirement income comes from Social Security, it's 50% of married couples, 71% of non-married individuals. And then for 90% of their income in retirement comes from Social Security, 23% of couples, 43% of non-married individuals, which basically are predominantly women because they live longer, fall into that category. So pretty substantial numbers, right? Out of that 66 million people are getting most of their retirement income from Social Security. I'm trying this a number of ways and see how far we go. So here's the averages. The average for all retired workers, and this is new benefit awards as of the end of last year, it's about $1,400 per month. And for that multiplied times 12, it's about $17,000 for an aged widower, non-disabled. It's $12,000 or it's $1,000 a month. So about $12,000 a year for aged widower, aged couple, both receiving benefits, either both eligible for Social Security or one their own, and then spousal benefits. It's about $2,000 per month for $24,500 as average benefits. So again, think back to that previous slide where we were talking about how many people 50% of their income or 90% of their income comes from these numbers. Not very substantial numbers to live on in retirement. So that's why it's so important to take advantage of the company plans and save on your own to be able to build a bigger pool of dollars to live on. Full retirement age is important as well, and that's basically the age at which you're eligible to receive 100% of that calculated benefit. So remember I said when it started it was age 65. Today it's age 66, and it's quickly going to move to age 66 and months. Eventually it's going to move to age 67, depending on what year you were born. So if you were born prior to 1955, you're at 66. If you're born between 1955 and 59, it's going to add 2 months for each year, and then 1960 or later, it's age 67 is the full retirement age. We're going to talk about reductions that the Social Security Administration may apply to your benefit based on when you file in a minute here, but they start with this number. It's the full retirement age. So any questions on that? The other thing that's interesting, anybody born on January 1st? If you were, they would actually count it as if you were born in the year before. So they give you the benefit of that one day because it's a holiday for the Social Security Administration. It's a question.
How often do they review these numbers?
So these numbers are changed by congressional law.
Okay.
So it doesn't get reviewed. The actual calculation numbers that we're going to talk about here in a minute are reviewed annually. So two different things. This was changed by an act of Congress in 1983. It changed some things about Social Security. But to my knowledge, there haven't been any significant changes other than some filing benefits that occurred through the tax reconciliation of 2015. All right, my remote's not working. No, that's not what I want. I think I skipped a page here. So this is actually how they calculate your own benefit. They look at a 35-year work history. So if you remember getting the Social Security Administration statements, and every year they show how much you earn from the day you started working. They look at the highest 35 years. So a lot of people think it's the last 5, last 10. No, it's the highest 35. Question also comes up, well, what if I continue to work and I'm receiving Social Security? They're supposed to calculate this every year. So if your last year of employment exceeded one of the prior 35 years, then it's going to adjust your retirement benefit. And I've talked to individuals where that in fact is the case. They were over 70, continued to work, and their retirement benefit increased every year because this calculation changed. So it's the highest. If you work less than 35 years, those other years are 0. So it's the average of that. It's indexed because they have a factor or chart that they multiply a factor against those older numbers to kind of get it into today's dollars. I always say it's like an inflation adjustment, not quite, but it's something like similar to that, to give you an average monthly benefit, which is the average index monthly earnings, AIME, and then they apply this calculation to it. So it's 90% of that first $896, 32% of a range between $896 and $5,399, and 15% above that. The percentages are fixed by statute, which means it's act of Congress to change it. The dollar ranges, though, change with the cost of living adjustment. So that can actually go up year to year, depending on whether or not there's a change. So this actually did change this year. You also have to have 40 credits to be eligible for Social Security benefits. So 40 credits are determined by how much you earn as well. And this year, $1,320 is one credit. 4 times that amount gives you 4 credits. It's a maximum of 4 per year. So it takes 10 years basically to be eligible for retirement benefits under the Social Security Administration system. And their estimated maximum benefit is $2,788. I always have somebody say, well, wait a minute, I know somebody that has more than that. That's just their average benefit. So it's based on their big numbers, looking at everybody, not your own individual situation. That could be higher or lower depending on what those 35-year averages look like. You may have to switch the hand here. So the second option is, we talked about your benefits, right, until now. So now we're talking about spousal benefits. And the interesting thing about spousal benefits is whether or not you had those 40 credits, the spouse could be eligible for a benefit. All right? If they never worked outside the home, still could be eligible for a spousal benefit. In our example here, we have Sam and Kathy. Sam's retirement benefit is $2,000. Kathy's actually $800. She does work outside the home, and her spousal benefits equal to 50% of Sam's. Now, it could be reversed if Kathy made more than Sam, but it's 50% of the higher benefit is going to be considered the spousal benefits, and the Social Security Administration should let you know what the higher benefits are. So if, in fact, if Kathy and Sam went in to file, they would say you're eligible for spousal benefits as well. It is not either or, it's the combination of the two. So in our example here, Kathy's actually going to get her $800 retirement benefit, and then they're going to increase it by $200 to bring it up to that spousal limit. Okay? They have to be married for 12 months, and you can't be eligible for a spousal benefit until that primary earner is filed for benefits. Okay? So if there's a difference in ages, you might look at that. And these are at full retirement age. So for this year, it's 66. Surviving spouses also are eligible for a benefit, and it's a little bit different. So it's not the same 50% benefit that a current spouse has. It actually increases up to whatever the higher benefit would be eligible to receive. So in this example, it's Sam and Kathy again, although Kathy's retirement benefit is $1,400 per month. And if Sam passes away, she's going to step up to Sam's benefit because it's larger. Okay. So a couple of different things about survivor benefits is that you have to be at least 60 years old or 50 if you're disabled. So spousal benefits and retirement benefits are age 62. It's the minimum age. But survivor benefits, 2 years younger for most, would be eligible to receive a survivor benefit. And they have to be married for 9 months. So remember, it's 12 months in the spousal benefits. Survivor benefits is 9 months, could be even less. So if there's an accident involved, it could be a little bit less than that. So survivor benefits, spousal benefits, your own retirement benefits. This is the one that usually gets a lot of questions because it's ex-spouse benefits, and people didn't realize that ex-spouses are eligible for benefits as well. And in fact, it could be multiple ex-spouses. So I always tell the story that there was an article written about Johnny Carson, who was known for having multiple ex-spouses. And I think the calculation was that 3 were filing spousal benefits on his record. All right, current spouse, well, current spouse and 2 ex-spouses. Age 62 or older, has been married for 10 years or more, and divorced for 2 years if that ex-spouse is not yet filed for Social Security. Does that make sense? If they have already filed for Social Security, then the 2-year window doesn't apply. Okay, so ex-spouses are eligible. So usually the question does that decrease the current spouse benefit? And I said, no, it doesn't impact them at all. You know, whether there's 2 or 3, doesn't impact. They're all the spouses are eligible for 50% of that primary earner's record, right? And then some people kind of hope it did impact their benefits and others not. So it depends on what side of the fence you fall on that. Children are also eligible. So If your children are 18 or younger, or still in high school up to age 19, they could be eligible for Social Security benefits. So that could be survivor benefits, or it could be current retirement benefits. Still kind of under that 50% rule. Survivor benefits 75% for children. And disabled children even older than that are eligible for Social Security benefits. And the other thing that I don't have on here, which also qualifies as well, is if you have a spouse that's much younger and is actually taking care of minor children under the age of 16, that current spouse is eligible for benefits as well. So I had an example of an individual I was talking to in Seattle who was 66, had filed suspended under the old rules, which I'll explain later. And his current wife and their 10-year-old and their 12-year-old were all receiving Social Security benefits. Now what's interesting about that, as soon as those children turn 16, the current spouse wouldn't be eligible for spousal benefits until she reaches age 62. And then she'll be eligible for spousal benefits again. So it could be you'd be eligible for Social Security benefits, then not, and then eligible again depending on your age and the situation. The children again. The other thing about children's benefits and spousal benefits is there's a family maximum that is applied, and it's somewhere between 140% and 188%. It's a multiple tiered calculation to determine how much that is, and then it's a pro rata split of that total maximum. So you could bump up to, if you had 5 children, and they were all eligible to receive Social Security, they don't all get 50% or 75%. Okay, so they'd only get part of that. This is showing you what happens with your benefits depending on when you file, and I have 2 ages here. The darker bar or column is age 66 is your full retirement age. If you were at full retirement age this year, it is 66. For age 67, it's the other, and what that shows you is that it's a 25% reduction for those that are filing at age 62 if their full retirement age is 66. It's a 30% reduction if they file at 62 and their full retirement age is 67. And that calculation is based on 5/9% for 36 months, 5/12% for any months beyond that. And if you delay till after your full retirement age, you get an earnings credit. So that's 2/3% for each month you delay. So if you wait until age 70, you could be eligible for a 24% gain or a 32% gain, because it's 1% for each month, times 12 is 8%, times 3 years would be 24, 4 years 32. So it's a month-by-month calculation. So a lot of times you'll see that there's tens of thousands of different filing strategies for Social Security. They're looking at from age 62 to age 70 for you and your spouse, and all the different ways that you could start collecting. So it's tens of thousands of different. So that makes sense? The other thing about the 2/3, people say, should I wait to collect Social Security? And it's an individual decision. It's based on a lot of factors. But I will tell you, in the finance industry, we can't guarantee you an 8% return. The government can through this program. But if you're investing money, then you'd have to look at that compared to delaying taking Social Security and getting a guaranteed increase for your Social Security check, right? And then after that, the cost of living adjustments would be applied in and over above that. Any questions on that? Reductions if you file early, increases if you file later. So this is one that impacts individuals that do not pay into the Social Security Administration. There's 15 states in the country there. The teachers in those states do not pay Social Security tax, and they're eligible for the state pension plan. And if that is in fact the case, they're going to reduce their Social Security benefit by 2/3 of their pension plan. So it could be teachers, it could be government employees, it could be municipalities, it could be not-for-profits. If they do not pay Social Security tax, they fall into these 2 categories. You say, well, wait a minute, they didn't pay Social Security, they're not eligible. They're eligible for spousal benefits. So if that's the case, a lot of the teachers I talk to say they're not eligible because the 2/3 is greater than the spousal benefit, so it takes it down to 0. Windfall elimination program is if you worked for both systems. And what I mean by that is, let's say you taught in one of those states, you didn't pay Social Security, but you also had a for-profit job, and you may pay Social Security on that job. So then if you paid into that job for 30 years, that calculation goes away, it doesn't get reduced. Less than 20 years, it drops down to 40, and in between 20 and 30, it prorated back up from 40 to 90. If this doesn't apply, don't worry about it. It's just one of those reductions that they have that may adjust your Social Security retirement benefits. So the next reduction applies to a pretty significant number of people. Because the average person that starts receiving Social Security, almost 50% start at age 62. And if they continue to work, this earnings test comes into play. And so effectively what it says is that if you continue to work, you are not yet full retirement age, and you're receiving Social Security, we're going to have this earnings test. And if this year, if you earn in excess of $17,040, for every $2 over that amount, they're going to reduce your benefit by $1. And in the year in which you turn full retirement age, so 66 for this year, it's $45,360, and every $3 above that, they're going to reduce your retirement benefit by $1. So let me give you an example, because it's not like, first of all, when you apply for Social Security benefits and you continue to work, they're going to ask you to estimate what your annual income is going to be. They're going to use that number to determine whether or not there's a reduction involved. They will go back and check it, so you couldn't, if you put on 16,000 and you earn 40,000, they will readjust the numbers later. But let's just say you earn 37,040. You're $20,000 over that limit. You're 62, so this earnings test applies. They're going to reduce your Social Security benefit by $10,000, right? So 20,000 over, they're going to reduce it by $1 for every $2 over. $10,000 reduction. If you are eligible for a $2,000 monthly benefit, you won't get a check for 5 months. So it's not spread out over the year. It's up until you use up that amount based on that estimate. And then you'll get the $2,000 each month. Next year, same thing occurs. You're not going to get a check for 5 months again, and then they'll pay you the other ones. The other thing about the earnings test that is unusual, I think, is that all that money that they've taken back and they didn't pay you out, they add it back into the calculation as soon as you reach age 66. And they adjust your number back up. So it's a little bit different because they're adjusting for a 4-year time frame, and when they apply it back to the calculation, it's more like a 20-year time frame. So it's going to be a slight adjustment up. You may not notice it as much, but there's going to be a certain increase. And it's supposed to balance things out based on average life expectancies. Does that make sense? Earnings test, it is only W-2 wages. It's not distributions out of retirement plans. It's not capital gains on investments. It's just earnings, right? And if you have a spouse and children that are collecting on your record, it impacts them as well. And the reduction applies to them as well. They just don't get it added back into their calculation. Right? So that's the earnings test. Yes?
Are all Social Security earnings fully taxable?
Depends on what range you're in. So we're going to cover that next. So that's this one. So yes, they may be subject to taxes, but it's never 100%. So if you're a single filer and you fall in that range between 25 and 34,000, then 50% of your Social Security benefits is going to be subject to marginal tax rates. If you're above 34,000, it goes to 85% of your Social Security benefit will be subject to marginal tax rates. For married couples filing jointly, 32 to 44 for 50%, and above 44 it's going to be 85%. So here's the thing that's unusual about this calculation. It's not just earnings, it is all taxable income. In fact, in addition to taxable income, they add in non-taxable interest income. So municipal bond income, which typically not taxable, gets added into this number. It's a worksheet on your 1040. You'll put in all your numbers of the earnings you had, any capital gains, any distributions out of retirement plans, and 1/2 of your Social Security benefits to see where it falls in the range. So the range is determined including your Social Security numbers. And then there was, whatever marginal rate you're in at that time. All right. So depending on how large that total is, could impact how much your marginal tax rate is and how much tax you pay on that. But it is going to be subject to tax. They're not taking 50%. That's just the number they add into your taxable income amount. So now we get to the section of when should I start? And to me, it really is the primary factor you should look at is longevity. How long am I going to live? Keith would agree with me. If you know what that end date is, it's real easy to back into the numbers and tell you how much you have for each month, right? But nobody knows what that date is. This is a chart, and there's 2 pieces of information here, so I'll explain what we did here. I took a chart from actually the Society of Actuaries that looked at a group of 65-year-olds, estimated out the percentage of people that passed away each year, and in that calculation they said 21 years later, 50% were still alive. So if you do the math, that means 86 is their average life expectancy under that chart. This 84.3 is actually from the Social Security Administration. That's kind of the number they look at. Okay. So remember I said the reductions for filing early and the the increases for filing late. According to the Social Security Administration, if you add up all those monthly payments from 62 to 84.3, or from 66 to 84.3, or 70 to 84.3, they should all equal about the same thing, right? So I don't find it to be that case, but that's what they claim, and that's how they came up with those factors that they use. This is another chart that shows longevity as a projection from Society of Actuaries as well. This one just shows men, women, and either or. Of 65-year-old likelihood that they'll live 10, 20, or 30 years longer. So if they live 10 years longer, it's 86% of men, 91% of women, almost 100% likelihood one will live to 75. To 85, almost a 90% likelihood one will live to 85, 70% of women, 61% of men, and for 95, another 30 years after 65, 22% of men, 32% of women, and almost a 50% likelihood that one will live to 95. I always tell the story about my wife's family. Her uncle passed away at 104. Her great aunts lived into their 90s. Her mother just turned 92. So on her side of the family, I wouldn't say that happens on my side of the family, but on her side of the family, they're long-lived, right? So when I'm deciding about taking Social Security, I'm going to look at survivor benefits being maybe a significant factor in that. Because if she's going to live into her 90s and potentially up to 100, then having a higher monthly benefit over an extended period of time makes a lot of sense. Okay? Questions on that? So here are some generic guidelines. And again, we'll tell you that everybody's different. But from all the books I read and articles, they basically said, if you're trying to get the best benefit from the Social Security Administration and you're single, don't file before your full retirement age. Don't take the reduction. If you're a spouse and you have the lower benefit amount, file early. But if it's lost to the earnings test, then it probably doesn't make sense to do that. You'd have to see how much that has an impact to you. If you're a widow, here's the other thing about survivor benefits that I didn't mention before, is that unlike spousal benefits and your own retirement benefits, you can start with survivor benefits first and then switch to your benefit later, or start with your benefit first and switch to a survivor benefit later. And the reason you would do that is you're trying to maximize those two. Right? They kind of come out of different buckets, so they don't look at them the same, and so you can elect to start either or of those benefits. And so if your benefit's going to be half that of less than half of the spouse, then you want to claim yours at first and then try to maximize that survivor benefit. If yours is going to be higher at 70 because of the earnings credit, you're going to take the survivor benefit first and then file for your benefit later at age 70 where you've got a higher monthly benefit. So again, just to remind everyone, age 62, it's a 25% reduction. Age 66, it's 100%. Age 70, it's a 32% gain, so it's 132% of that retirement estimate. So here's if you didn't catch this. If you're age 62 this year, your full retirement age is not 66. It's 66 in 4 months. So the real adjustment, if you're 62 this year, it's going to be at 73%. It's going to be a 27% reduction because of the extra 4 months in that calculation. So these are the changes. Anybody familiar with file and suspend and file for restricted benefits? I get a lot of questions on this, the people that are trying to file and are trying to take advantage of these different benefits. Prior to May 1st of 2016, there were different rules that were effective. You could file for benefits at age 66 and suspend, and your spouse and children that were eligible to receive a benefit could get their benefit. And then at age 70, you turn yours on. If you were both about the same in terms of retirement benefit, one could file for spousal only, the other could file and suspend, and then at age 70, both turn their own on, and then they would get the maximum benefit out of the Social Security Administration. The Budget Act of 2015 changed that, changed the definition of those two strategies, effectively almost eliminated one, that's file and suspend. So now if you file and suspend at age 66, it basically shuts off all payments. Yours, you can't file for spousal benefits. You know, any spouse that was on your record would not be able to receive a benefit either. So I say for all intents and purposes, it no longer exists. There's only a limited example where I can use that. It makes sense to do that. File for restricted application. A lot of people get confused because they think they're suspending their application. They are not. At 66, if you were age 62 prior to the end of 2015. Technically, prior to January 1st, or if you were born on January 1st of 2016, you were still eligible for this file for restricted benefit. But it puts you in that age group, right? If you were already doing these two strategies, you were grandfathered in. If you were in that age group that you were 62 as of the end of 2015, still could file for restricted benefit. There's 2 years left on that group. They're going to turn 66 this year and next year, and they're going to be able to just say, I want spousal benefits only, and then I'll get the earnings credit up to age 70, and then I'll collect my own increased benefit. In order for that to happen now, though, your spouse has to have filed for Social Security benefits, because remember, the spousal benefits, you have to file in order to be able to receive that spousal benefit. So it's a little bit different, but yes, it still applies. If you call the Social Security Administration today and say you want to file for restricted benefit, more times than not, they'll tell you you can't. Now, if you are in that age group, you can. So they don't get this one right very often. They had 2 emergency emails in after November of 2015 that kind of explained how to work these new rules under the new format. But just know for a select group, it's still available. If you're younger than that, if you were not 62 in 2015, then it doesn't apply. And don't worry about them because they basically don't exist anymore. Right. Here's a calculator from the Social Security Administration's website. I think it's useful to look at a calculator because it gives you kind of the break even. If I file early, what does that mean? If I file later, how many dollars are involved? At what point in time does it make sense to have filed one way versus the other? And that's what the break-even analysis does. Social Security Administration's website is pretty basic. It'll tell you the 62, 66, and 70 dollar amounts, depending on what information you put in. If you go online and set up your account, so you put in a password and an ID so that you could go in any day and look at your information and print off a statement. So I recommend that to people just because it's added identity theft security protection, right? Because no one else has access to your information. And identity theft's becoming a bigger issue. Social Security numbers are one of the things that they're after. If you protect it by having a password on your information, that restricts the ability of people to get that information. There are maybe a dozen different calculators out there. I know some. Social Security Solutions and Maximize My Social Security are 2 of the calculators. This is not an endorsement. I just know that both those individuals have written books, so they're considered experts in the industry. Those calculators, you put all that information in. There's a nominal expense to use that website or that calculator, but it'll tell you down to the month when you should file based on how to maximize those numbers. So here's some examples. In our example, Kathy was eligible for $700 in her retirement benefit at age 66, and Sam was eligible for $2,400 at his full retirement age of 66. And we're saying, well, Kathy should file early. She's not going to be subject to an earnings test in our example here. She's going to file early. She's going to take a 25% reduction. So her $700 drops down to $525 per month. And then Sam wants to maximize his to age 70, so he gets the 32% gain. And now he's going to be eligible for $3,168 at age 70. And because then he's filed, Kathy's going to be eligible for spousal benefits at that point in time. And her benefit's going to increase to $1,000.25, which is not half of $1,200. What they did is they took $700, subtracted it from $1,200 to come up with $500 spousal benefit, and added it to her amount that she was now eligible to receive when Sam files for benefit. Does that make sense? Because she filed early on her retirement benefit, there was a reduction. It did not apply to the additional amount she was eligible because she was past full retirement age when she actually started getting spousal benefits. If Sam filed at age 66 and Kathy was 4 years younger, age 62, and she filed for spousal benefits, she would have gotten $1,200 reduced by 25%. Okay, so she'd been eligible for $900. Did I do that math right? Yeah, I think so. Okay, does that make sense? So let's look at the chart. So I've run a lot of these break-even analysis, and effectively I think the numbers come out to be about the same, and it depends on your situation. It depends on how close the retirement benefits are between spouses. It depends on the age differences. But in our example, since they're both the same age, Kathy's filing early all the way on all three of these options, but Sam either files at 66, 60, or 62, 66, or 70. And what you'll see is the break-even is somewhere around 77 to 78 for the 62 versus 66, about 81 or 82 for the early versus the 70, and about 85 for the 66 versus 70. So that's when the accumulated dollars. Now I'll tell you that these are basic calculations. I just looked at the amount of money they were eligible to receive each month and just added those up over those time frames, and that's what what those lines represent. So it doesn't take into consideration any cost of living adjustments over that time. It doesn't take into consideration any investment earnings outside of that. It's just it's a basic analysis. This is a little bit different, and it shows the restricted filing as well. Both eligible for about the same retirement benefit. So in order to maximize those, they're both going to want to wait till age 70 to collect their full earnings credit. But because they were 62 as of the end of 2015, Sam can file for spousal benefits only at age 66. So Kathy files at her full retirement age, then Sam gets his 50% benefit of $1,050 or $1,050 per month, and then he switches his on at full retirement age, and then of course the survivor benefits are what he would have been was receiving. Okay? So if we look at the chart, it gets more confusing because there's more lines, but effectively, remember I said that 77, 78 for the 62, 66, about 80, 82 kind of for the other ranges. And then if we look at this file restricted, because Sam's now getting a spousal benefit for 4 years and he's also maximized his own benefit, it almost takes till age 86 for that to break even with the both filing at 70. Okay? So that's kind of where the numbers. Everybody's different. I was looking at one 2 weeks ago, and based on what I had looked at previously, it always kind of made sense for them to file it at age 70. But I came across a calculation because it was enough difference in the retirement benefits and age that it made sense for the higher benefit to file at age 68 and get the spousal benefit for an extra 2 years, and because it was like a 18-year payback, which meant they would be 88 before they hit break even, so it didn't really make a lot of sense to wait on that one. So depending on your situation, the break evens could be different, and that's why I think the calculators help. This is just an example of a survivor benefit filing, and because they're both the same, Kathy could maximize her own benefit at age 70, so she takes the survivor benefit with the reduction at age 60, and then changes to her own later. So has anybody heard of do-over option? So I will tell you, this used to be a great deal. Back before December 2010, you could file for Social Security at age 62, invest all those dollars for 8 years, and pay it all back to the Social Security Administration and pocket the earnings. All right, great deal. We used to recommend that people do that. They changed the rule because they figured out it was an 8-year interest-free loan. It's not a good deal for them, right? They now say that within the first 12 months, you can pay back Social Security Administration and start over, or make a different decision on when you want to file. So you're saying, why would someone do that? Let's say you're unemployed at age 62 and you need the money. 6 months later you get a job, no longer need the money. You could pay back Social Security Administration all those dollars and then refile 66, 70, and whenever you want to after that point, right? So that's the do-over option. I've had people say, wished I hadn't filed at 62, is there anything I can do? And I will say, are you within the first 12 months? And if the answer is yes, do-over options available. If it's month 13, no longer available. And then their only option is to wait till age 66, which is full retirement age, and then they could file and suspend if they wanted to, and they would get earnings credits for those months they didn't receive Social Security up to age 70. Okay? So that's the do-over option. How to file. So anybody that has called into the Social Security Administration, and I know you have, expect a long delay for them to answer the phone. They say file online is probably a better option because it's easier to accomplish what you're trying to get done. But you can go into an office, you can call for an appointment, set up an appointment, go into the office. I would just say that if you're going to do that, just, it pays to do your homework beforehand. and know what your options are, and then explain what you're trying to accomplish. Because if you don't use the right terminology, sometimes they don't give you the answer you're looking for. You can file up to 3 months in advance, and that's generally the recommendation. If you want to file start collecting at a certain age, 3 months prior to that. So if 62 is your start date, up to 3 months before that, you can't do it any earlier than that. And anytime after that, you can technically file 6 months retroactively. And they'll tell you that. I mean, if you go to the Social Security Administration, they'll say, if you're 63, they'll say, hey, we can give you a lump sum check for 6 months. But what they probably neglect to tell you is that they've already, then if you do that, they're going to reduce your monthly benefit by that 6-month calculation. Okay, so just be aware of that. So socialsecurity.gov or ssa.gov is their website. There's a lot of good information out there. Keith has better worksheets than I have here, but this is just to give you an idea that if you're going to look at making a decision about when to file for Social Security, you're going to look at what your age is now, if you're going to continue to work, between you and your spouse, where money's going to come from. If you want to delay till age 70 collecting Social Security, if you're going to continue to work, that's another option as well. All of those things come into consideration. So how many think Social Security is going to go away? Yeah. If I talk to millennials, it's almost 100%. I think it's going to go away permanently. Not going to exist when I get to retirement age. This chart does a pretty good job of showing where we are today. Every year, the Social Security Administration sends out their annual report that effectively says, here's where we are. We've got this amount of expenditures, we've got this amount of income coming in, and here's kind of where we're going to be. They do a 75-year projection. So I always say, I'm not sure they can calculate next year, let alone 75 years down the road, but be that as it may, here's what they've suggested. And the numbers haven't changed all that much. This darker line here is expenses. So you can see prior to 2010, this lighter line says non-interest income. That's tax revenue. And so prior to 2010, they collected more money than they spent. And those dollars were then set aside in the Social Security Administration's trust fund, of which they bought government bonds. And those are collecting interest today. And today, because we're no longer in that situation, the interest from the bonds is paying for the difference. Okay, so we're in a deficit, but the interest still covers that. The projection is in 2034, they're going to run out of trust fund money, which means they're going to cash in all the bonds. The only money they're going to have available to pay benefits is going to come from tax receipts, and that's only will only cover 23% or 77% of the benefit. 23% reduction for everybody that's receiving Social Security benefits in 2034 if they do nothing. So I don't know about you, but I'm pretty sure that's not going to happen. What they do, I don't know. We've got some options that I'll lay out for you, but I'm pretty sure that they'll be all unemployed if they do let that happen, right? We'll all vote them out of office. So, in 2010, there was a commission called Simpson-Bowles that put together recommendations for what to do with Social Security, how to fix the deficit. And I'll go through the options. It's basically reduce benefits or increase taxes. The only two options they have. And under the increased taxes, they could say, you know what, we're going to apply Social Security tax to all wages earned. No more taxable wage base. 100% of the dollars you earn are going to be subject to Social Security tax. And a lot of people say, well, they should do that. You should pay it on all their money that you earn. It doesn't fix the problem. It only covers about, I think last estimate I saw was somewhere around 40% of the gap. So you would think it would have a bigger dent than that. It does not. You could increase payroll tax from 12.4 today, which is the Social Security part of the tax of your withholdings, up to 15.76, which is 2.76% increase. That's one way. You could decrease or increase the full retirement age from 67 to 68, 69, 70, depending on what year you were born. You could adopt change CPI. So today is CPIW, which is the urban wage earners cost of living adjustment or numbers, and that's how they adjust Social Security benefits payments. Change CPI basically reduces the amount of the increase. So that's how they impact. That's why it's a reduced benefit. They could cut benefits immediately by 17%. I can guarantee that'll never happen. They're not going to make that kind of change. They could reduce benefits for those with lifetime wages above a certain national average, which is a means test, and potentially they could look at that as well. Are they looking at all these? Yes, they know that these are the potential solutions to the problem. They know what they are. They've known them for 8 years. In 2010, the increased tax recommendation was 0.1% for 20 years in a row. Total of 2% over a 20-year time frame. I, for one, would never have noticed. They opted not to do that. In fact, they've opted not to do anything until even through today, right? So the longer we wait, the bigger the adjustment's going to be to fix the problem. So they're going to have to get something fairly quickly. I don't know if there's any guarantee it's going to happen in the next couple of years, but I will tell you that there are probably no less than 3 pieces of pending legislation that address some of these issues. 5 years ago, there wasn't one. In fact, it wasn't even on anybody's discussion. There's a lot of discussion about Social Security and entitlement benefits right now. So we're getting closer. My opinion is it's going to be a combination of increased taxes by virtue of increasing the taxable wage base, potentially an increase to the overall tax itself, and increasing the full retirement age. And the reason I say that, somewhat cynically, is because some of that group isn't voting yet, so it doesn't impact them at all in Washington, and they've already done it once, right? They went from 65 to 66 and potentially 67. They could continue to increase it, and the justification would be people are living longer, so they should be able to work longer. So that's just my opinion on how that would work. Questions on that? So we covered the basics. We talked about how it works and how they run your calculations and determine your benefit amounts. We talked about when's the best time to take Social Security. So, we have questions about anything? Did you learn something new? I'll leave you with this thought. There's an individual by the name of Lawrence Kotlikoff who wrote a book called Get What's Yours. It's all about Social Security filing and all the different strategies involved with that. And his recommendation is to go to 5 different Social Security offices and take the best offer. So, unfortunately, it's not supposed to work that way, but you just don't know. It depends on the experience level of the people you're dealing with. Keith?
Thank you. Any questions? The expert's here. I want to say, go ahead.
Okay, I might be wrong, but in the beginning of your presentation, you said if a spouse took their Social Security benefit, and I'm just going to round numbers off, and it was $1,000, and their spouse was entitled to, say, $2,000, but if they were married, they had a maximum of $2,400? So
the family benefit limit is based on the primary earners, and it's somewhere between 140 and 180%, but that's just based on the spousal and children benefit, not the individual that it's. So that makes sense. So if the primary earner or the primary benefit amount is the $2,400, and the spousal benefit's 50% of that, which is $1,200, and you have children that are, you have 4 children that are all eligible for Social Security benefits, then there is an adjustment that takes place if it exceeds a certain number. That generally won't happen unless you have more than 2 children on that as well. Does that make sense? Because you have to have numbers that exceed that.
Okay, so if my husband would get $1,000 now, I mean, he retired when he was 62,
Okay.
and then I'm eligible for $2,000 when I retire at 66, would that be would we get a total of $3,000?
Correct.
Okay, so that's what I'm.
Yeah. So if there was a bigger difference, there potentially could be an adjustment up for the spousal benefit. But in your example, the spousal benefit was equal to the benefit he was currently receiving, and then he filed at 62, so it'd be an adjustment. He's already taken the adjustment down for filing early. So it would have to be a large enough difference so that at full retirement age, it was more than what his benefit. See, what I'm saying is that you could have an adjustment up for a spousal benefit if, in fact, there was a big enough gap that allowed for an increase at full retirement, like the example we used, where Kathy had $700 and she took it early, and then because her spousal benefit was much larger, as soon as her husband filed, she got an increase in the amount she was receiving. It's a combination of the two. So, in your situation, you're both eligible for retirement benefits. That's not subject to a family maximum. It's only if the benefits that are based on the other's benefits, so spousal and children's benefits. Yeah. Yes?
Are there special rules for if a spouse is deceased before the other gets full retirement?
Yeah, there's actually a calculation that occurs, and effectively, the easy way to explain this is if they were receiving Social Security, it's going to be whatever they were eligible to receive. If they were over full retirement age, it's going to be whatever. I'll get to the last one here in a minute. If they're eligible but not yet receiving Social Security and they're over retirement age, it's whatever they would have been eligible at that date. Okay, so they would have got the earnings credit. They'd be eligible for that amount as a survivor benefit. If they passed away before 60, for example, the survivor benefit's still based on the full retirement age benefit. and then it's adjusted, so there's a two-tiered calculation in there that tells you how much it's going to be, but that's a recommendation. I would say call the Social Security Administration to find out what those dollar amounts are, but it's going to be somewhere between, you know, that full retirement age benefit and the reduced benefit from age 62 type thing, so it's going to fall in that range. Typically, for people where that situation occurs, a lot of times you'd want to file, if you want to try to maximize a survivor benefit, you'd file somewhere around 65 to 66 because that maximizes that number. But I'll tell you, it's a two-tier calculation, and I don't go into that because it's complicated enough just to say it's a two-tiered calculation, so it's worth calling in for that. Other questions? Yes?
I was under the impression that once you hit full retirement age, it didn't matter how much money you made, you didn't have to pay taxes. It looked like on your chart, the year that you retire, they do taxes.
Two different things. Okay, so we're talking about the earnings test here, so that when you reach full retirement age, it doesn't matter how much you earn after that date and receive Social Security, the earnings test does not apply. Okay?
If I return full retirement age in March, I only have to worry about my income January, February, March.
Technically, you do not. So the only time you have to worry about the earnings test is if you are not yet full retirement age and you're receiving Social Security and you have earnings. So all three of those conditions apply. So let's say, I'll go further out. Let's say you're full retirement, you're October, you're going to turn 66, and you earn, you know, $60,000 between January and October, and you file for retirement benefits in October, but you're not going to continue to work. Doesn't matter, because you already hit the full retirement age, and you hadn't yet received Social Security benefits, so they're not going to look at your earnings prior to that. Okay.
But if you do reach full retirement age and you're going to continue to work, doesn't the earnings test come for the months before you reach full retirement age?
If remember, there has three qualifiers. It has to be when you start receiving Social Security. See, there is a special exemption built into the rule that says that it doesn't matter if you earned in excess of that prior to filing for Social Security, if in fact you hit full retirement age at that point, right? If you filed 2 months earlier, though, they'd look at a month-by-month calculation on that.
I have another question.
Yes.
What if I take my benefits at age 66 and I continue to work? I still pay Social Security tax on the money I make?
Yes.
Where does that money go? Do I need credit for any of that?
Yes, you do. So here's what happens. You reach full retirement age, continue to work, start taking Social Security, they're still going to be subject to Social Security tax. Remember, if you're 75 and working, you're going to be subject to Social Security tax. What happens, though, is they should look at that dollar amount that you earned, and that recalculates into that 35-year history. And if that last year is greater than one of the prior 35 years, it should adjust your benefit up. So it will adjust the calculation. It's supposed to.
So at age 66, I get $2,500 a month, and it says at 70, I get $3,300 a month. If I work till age 70, if I start taking my $2,500 at age 66, will I jump up to $3,300 when I turn 70?
No, probably not. No.
That's what I mean.
No.
I would say, what benefit is there not to take it if I'm going to get it anyways?
It's based on life expectancy, because the accumulated value of those monthly payments will exceed the other if you live beyond average life expectancy, or whatever the break-evens are.
So how much of that $800 difference will I recover at age 70? Do you have any idea?
Yeah, it's generally around 82 to 83 before you break even, and after that you're better off to have waited. Generally, that's how that break-even analysis works. In most, it depends on how long you're going to live, right? So if you're going to live beyond 84, 85, then you could say, yeah, it makes sense to wait till age 70. If you don't think that's going to be the case, then you're going to have to, if other factors, because you could be looking at survivor benefits as well and saying, it's not only me, but I want a larger overall Social Security payment for my spouse, So it's a combination of all of those. But you're right, it's not going to be the 32% gain from 66 to 70, because that's going to be larger than potentially any adjustment, unless you're earning a lot of money and it replaces dollars at a much lower level, then it could have an impact, but I don't know that it would be an 8% increase at any level. Other questions?
What was the website or the email address you sent to get a copy of that thing? You didn't give us your email address.
I'll give you a card
Okay.
on your way out. Okay. Anybody that wants to write it down, it's K. Warmbein, WARMBEIN, @carnegieinvest.com. Any other questions before we wrap up? I just want to say this about a couple of slides ago. If I ask Al to back it up in going back to the state of affairs with Social Security, there's a lot of frightening things here, which makes your retirement plan and your
didn't work.
savings even more critical. And it would be beneficial to everyone to reevaluate how much you're putting aside into the 401k. This could have been fixed a long time ago. I think Al will agree with that. It's not a popular subject for politicians, right? They'd rather keep their hands off, kick it down the road, and let someone else deal with it. And now we are the recipients of that. It's unfortunate, but it's reality. We are where we are, and again, it's of paramount importance that you reevaluate your contributions, not only to your short-term savings, but to your long-term savings, okay? Any other questions? Okay, I want to thank Al for being here today. I hope all of you will join me.
Thank you. Thank you.